I'm Cameron Richards. I'm the Director of Survey here at ReSource Pro. With me today is Steve Hansen. He's the CEO of Utah Local Governments Trust. And just to give you guys a little bit of history, I was a part of a company called Lowry and Associates. If you've heard of that, we do premium audits and loss control surveys. 18 months ago, we joined ReSource Pro and are happy with that decision and how that's worked out for us. But Steve here has been a long time partner with us way back from 2016 when he was with Lowry and Associates, partnered with them to do their loss control and premium audit program. And that partnership's continued here to ReSource Pro today. So Steve, please tell us a little about yourself.
Great.
And tell us a little bit about the trust so that our group here can understand.
Well, Cameron, thanks. My name is Stephen Hansen, the CEO of the Utah Local Governments Trust in Salt Lake City, Utah, headquartered out in North Salt Lake, actually. We insure 650 government entities across the state as an insurance pool. We cover workers' compensation, property, and liability insurance. And we've been around for 50 years. We have an incredible team of individuals. We do a lot of outsourcing. We really rely on our partners like Lowry and Associates to help us accomplish the goals and objectives of our organization. And that's who we are.
Perfect, thank you. So those of you who are out there in the property space, you know that it is very volatile, and in the last 8 to 10 years is changing rapidly, right? And so today we're going to look at how you as an organization can get ahead of that and look at what Utah Local Governments Trust is doing to stay ahead of it, and really noticing that your books can get outdated very quickly in regards to exposure. They're changing much faster than the underwriting cycle can keep up with it. And then with just the ITV and the valuation costs that come along with that as well. So let's take a look at what is going on out there in the market today. So here's some big names for you and some things that they have said and what they're seeing out in the market. As Steve, I'll just point out that last one from the Hartford noting 20 to 40% increase in their property values. As you've looked at your book, as many as you have you noticed a large gap in where your replacement cost is noted and what we're seeing today?
Good question. We certainly don't want to see these kinds of numbers. That's why we do regular audits, right? And regular inspections, regular property valuations. With our program, we insure tens of thousands of buildings, and so property values are critical. And in fact, the actual value is really the core of what property insurance is based on. And if the values are wrong, the program's wrong. And it's really that simple. And so we have put in process programs to make sure that on a regular basis we're going out and inspecting and updating the values so that we don't have these, because this isn't uncommon in the industry. We see these kinds of numbers across pooling entities across the country where losses occur and there are big disconnects. Even in our programs that we are very proactive about, we have seen some numbers that have been off. And of course, we take the first $5 million of every loss, and so it means a lot.
Think about that within your own organization, right, Steve? They're taking that first $5 million on themselves, right? So think about where your threshold is when claims happen, how much of that falls directly onto you, and what can we do to not reach that $5 million or whatever your threshold is, right? And also noting that with that underexposure, you're dealing with your mispriced premiums, you're missing out on, you have your incorrect limits, your volatility within your own business, and then if you're using a reinsurer, right, if you're having all these problems in your gaps, you have an issue dealing with your reinsurer as well as more and more problems start to arise. So what is this value gap? Well, inflation, right, is the very most common thing that you think of, right? Because inflation hits us in our professional lives as we look at properties, but it also hits us in our personal lives, right? So it's very in the front of our minds. I have 4 small kids at home, and my wife comes home from the grocery store every week and just tells me, our same haul is this much more expensive this week. Is this much more this week? And it just keeps going up, right? And so that is a large part of our value gap is inflation, but it's a lot more than that. It's using outdated data. How often are you going out and looking at these properties? Unreported improvements, right? How often you're looking at personal lines, the homeowner is proudly putting that second story game room above their garage, and that they neglect to tell their insurance provider about it, right? All of a sudden, if something happens there, your adjuster's gonna go out there and be like, what is this? This isn't anything what we have written for you, right? You have an issue there. And then you're changing the risk profiles, right? Operations change. People pivot their businesses and do different things. Conditions around those. But here's our 3-legged approach to modern loss control. So, Steve, here's where I want to get a little bit more into the trust and what you do here. So tell us about how you schedule your routine surveys, how often you're doing ITV reports, and then what are you doing with your data to help you drive insights and make decisions?
Terrific. So what we do is we schedule our actual inspections and appraisals on a every 5-year basis. So each year we're doing 20% of our book. Some carriers, we're a carrier, so some carriers do that every 3 years. We found 5 years to be a good number for us. And so we send all of that information. In fact, Lowry, now we have APIs, so it's very integrated, very seamless, and that's been a super big advantage to us to be able to work that way. But we send all of our data now just electronically. They go out and inspect and appraise those properties, boots on the ground. That's very important because we're a member-owned organization. And so to us, we want to make sure that our members receive white glove treatment and just have full confidence. We're selling confidence, right? We need to make sure that they realize that we take this seriously, that we're looking at their values. We're making sure that the insured to value ratio is correct. And so we do that. Now, in addition, one thing that we've added that I want to just talk about, Cameron, that you've been really helpful with, is a few years ago we determined that, hey, look, you're out there doing these property appraisals. Let's have you do some loss prevention while we're at it. We have our own loss prevention team, but we are not on the ground looking at all these buildings, and that's the perfect time to really take a look at things. And what we had found is that we had some properties in our schedule that were seriously dilapidated and really, in some regards, uninsurable, not something that we would want to insure. Candidly, a lot of properties that our members probably didn't want insured other than just debris removal or something like that. This was a super big advantage to us to have your team go out and actually identify those and help us work with our members to make sure that these are properties that either should be scheduled for just debris removal or not. And I'll tell you, unless you're actually raising the hood and looking, checking the oil stick, you're going to miss stuff. And I mean, even with our program, as good as what we think we have, we're always improving it. It can always be improved, but there are things that fall through the crack. And so the biggest risk I see for, my colleagues across the country is that false sense of security that, hey, everything's fine. We don't need to, we rely on the internet to tell us what the values are. I mean, that doesn't work. When you actually go out and raise the hood, I guarantee you that you will find lots of things. And as we know, if we're using bad values in a property program, bad values can potentially destabilize an entire program. For those who don't take as much risk as we do, $5 million, you're still destabilizing the program because you're putting out the potential of blowing up a program that your reinsurers are partnered with. And so there's enormous risk if you aren't doing it right. If you're not looking at those values on a regular basis, it's a guess at best.
But with that, you mentioned every 5 years. To some people, that sounds very reasonable. To some, that maybe, they're going out a lot. And others may be like, they're not doing it enough. What are you doing in between those 5 years to make sure that your values are staying up with the times?
Great question. And the answer to that is trending. we have to make sure that you're trending on an annual basis, and we do that annually. So we look at what the numbers should be. We trend the entire book by the values that we receive, and they're easy to find. You can get good, solid construction cost value, barometers, and we add that to the schedule each year. We do that, again, to protect the member. We don't want to be insuring, if we don't have accurate values, we're really putting the pressure on all the other members to pick up losses that they didn't pay for, and that's not the right thing.
With a municipality like the trust insures, they may have a list of properties that are a couple hundred long. And so those can get kind of lost with the people as they sell a building. They insure everything from the big city water tanks that you see out there all the way down to the play set at the city playground, right? So there's a wide range of things that we're constantly looking at for them, and they're always looking at in their book as well. But how easy is it for your members to add a property or get rid of a property and just completely forget to tell you about it and still think that they're covered for that?
Yeah, it's very easy. I mean, there's so many moving parts in any organization, especially governments. They wear a lot of hats, and so there's lots of stuff going on. It's very easy for a member to mistakenly not add something, and that can cause some real problems.
Thank you. So let's look at some real world examples. These are mostly commercial, but some of these might hit home to you, right? So there's a commercial building, there's been a complete renovated interior, a new HVAC system was installed, and we find that the replacement cost is undervalued by 42%, simply because they did all these things without telling the insurance company, hey, look, we've made these improvements. We need to make sure our coverage is up to date. Manufacturing, add new equipment, expanding floor space. Obviously, anytime you add square footage or something, right, your valuation is going to change dramatically. And then a retail strip center. This is one that we see time and time again, right? We go out there one year, in Suite B, there's a salon there. And then 2 years later, we go back out there, and in Suite B, there's a restaurant in there, right? Completely different exposures that are there. The carrier and MGA don't know about, right? And so if a loss were to happen into that restaurant, what happens at that point? So Steve, what's your methodology? So if you have a value on your books that's a year old that says a building's worth $1 million and it catches fire and you find that the real replacement cost to bring it back is $1.3 million, are you only paying your members $1 million, or are you covering that whole 1.3?
We cover the full loss. We insure replacement cost. We don't have co-insurance clauses. I mean, they are relying on us as a service to do those appraisals. And so we need to make sure they're right. And that puts the pressure on us to make sure we're delivering, that level of service. Now, one thing I will say that we do that may be a little bit unique, and that is that when our appraisers go out and do those appraisals, we actually have the member sign off on those. It's not just they go out and we've done it and they're off site. We actually have LAI work with our members. We do that on the audit side as well, because they do our workers' compensation audits, and actually sign off that everything is on this schedule. So, we want them to feel that good pressure of realizing they're putting their name on this, that they've gone through the schedule, they've matched this up with the fixed asset system, because we don't have any way of knowing where all the properties are. I mean, they come into a city or town and there could be buildings all over the place. And so we want our partner to really truthfully partner with us on that. But yes, we pay the full loss.
And that's a key piece right there. That member sign off, I think, is unique to of your business process. And we have found many times that we'll go out and we'll go look at the whole building schedule that they have, and then they'll realize, oh, wait a minute, we have this new facility over here and this one here, and oh, we forgot about this one. And this one, we didn't want insured last year, but this year we decided, we might want to add that to our schedule. And so we see that all the time. And so in those situations, their schedule's growing, and so their total replacement cost is growing, which obviously results in more premium. But when you have those accurate buildings and those accurate numbers, it really is a benefit to everyone, right? It's a benefit to the policyholder because they know that they're actually covered for what they have. And it's a huge benefit to the carrier because now when a claim happens, they've been collecting the appropriate amount of premium this whole time. And so it's not such a surprise to them when they see the value when they replace that building.
And let me just add, we owe it to our members as a pool. Our members kind of own us, right? And so we want to make sure that we're living up to what their expectations are. And of course, any owner would want to make darn sure that what's being insured is accurate and correct.
So over the years of you and I working together and looking at all of your different properties, do you have any, or maybe even before we were with you, do you have any memories of looking at a schedule or an individual property and realizing from that loss control report, wow, we were really underinsured on this one?
Absolutely. We recognized that years ago before we entered into an agreement with LAI. And in fact, that's why we did that. We realized that it was more effective for us to partner with a firm that actually specializes in this, that could partner with us. So they go out as really an extension of the Utah local government's trust staff. And our members know who they are. They're familiar with them. They understand the process. And prior to that time, in fact, the first go-round, we found values that were enormously off the mark. And we did the same thing with our workers' compensation payroll audits. And we don't believe that our members were sending in numbers that were, incorrect intentionally or nefariously or anything like that. It's just that their expertise and their regular work role is not appraising commercial properties for replacement costs. And that's what you really need to do this right.
We may have people out here with different operations, and so they may just be looking at exposures with their loss control. They don't worry about the ITV. We may have some that are more worried about the ITV value than any general liability exposures that may be out there. In your book of business, are you doing ITV on 100% of your book?
Pretty much. Yeah, the materiality level is right from the bottom all the way up. We want to know what the values are. We have a scheduled policy. In order for coverage to exist, it needs to be on the policy, on the schedule. We do have unscheduled coverage, and all those things like all of our policies do, but limits and restrictions come into heavy play, when it's not scheduled. And so yes, we like to have all of our stuff scheduled. It's the right way to do it.
It is the right way to do it. And when those claims come in, do you have any type of way to verify what's happening there?
Absolutely.
Is it accurate?
Yeah, our adjusters have direct access to all of our databases, so we can go right in and they can determine what is on that schedule, right down to the vehicle and equipment and all that type of thing. And so they actually verify that, so we have a very clear picture. Now, there are times that they go in there and it's not there, and coverage doesn't play in that case. Our non-scheduled coverage steps in, but in some cases it doesn't do the job for them.
In those situations where you're coming to your member and you're saying, look, we were underinsured on these, we need to raise your values by 10, 15%. Do you find that to be a tough discussion? Are those members pushing back on that because they don't want their premiums to go up, or are they understanding and accepting that we want our full coverage, so let's make sure we get these values correct?
No, that's a great question. No, they appreciate it. When it's positioned right, and they understand that, look, what we really want here is correct insured to value ratio. They don't want to be underinsured, and we help them understand that's why we do these appraisals. And so, no, they appreciate it. They don't, they obviously, nobody likes to pay more premium, but what they don't want to have is uninsured property. And I will say this, that's another thing that helps with at least in our estimation, using an outsourced expert in this field. It's easy for the member to understand, hey, these are the experts that do this. They're trained in this. This is what their expertise is. Here's what the valuations are. And it's an easier sell than just us raising values without that level of expertise behind it.
That That's good to know, and that's helpful for your team, right? They have to go out and have that
yeah.
difficult conversation. A little different in your circumstance than someone who's dealing with one-off policies, right? Where, you may be telling someone that their house is worth more than, they think it is, and they don't want to pay that premium for it. But, you've got to convince them that you need to be covered for this much, because if something happens, you're going to really regret when that thing happens and you file that claim and you're not covered properly. So there's your 3-step action plan to think about as you go back to your organizations and after talking about this today. What are you going to do to review your portfolio and your policies that haven't had an ITV assessment in 3, 4, 5 years? Maybe identify your highest value accounts, areas where you think you might have the biggest exposure, and how are you going to do that analysis? How are you going to find those? And then we recommend building that ITV into your workflow. If you're out there just looking at the exposures, that's great. You may have a way that you try to find those values internally, but it's always important that you're keeping up to date with what we talk about, not just the inflation, but those renovations that weren't mentioned, and those changes in operations. They happen way more than you think. So always keep that in mind. Just because someone was doing something one day, I don't know how many of you were in the last session with Mike Warner with builders, but that's an industry where things change all the time. As the seasons change, they have to pivot, right? They may have on paper that they're an artisan contractor doing interior woodwork, or maybe they're doing stucco, and winter comes, and all of a sudden, they didn't tell you, but they're running a snowplow business on the side, right? So there's that exposure there that's out there, and it's everywhere. So that's why we're emphasizing the importance of making sure you know what's going on with your policyholders. And then to make it systemic, make that change be just a part of your everyday operations. Know where you're at in your cycles, know your high value accounts that are out there, know your industries that may be changing or may have additional exposures out there that need to be looked at. A classic example that we came across not too long ago, this man who had a very nice custom car collection, right? And he was housing it in this warehouse that he had. You wouldn't know from the outside that there was great car collection inside, right? Which is great for insurance companies, right? Because they're not flashy about the risk that's going on there. And that's all the insurance company knew about it. It's just my garage. I've got 4 or 5 classic cars in there. And so we go in there to check it out, and we go through it, and everything's looking fine, just like we expect. And then we get to the back, and all of a sudden he has a welder back there and a bunch of different metal sculptures, right? And our inspector's like, well, what's this? He's like, oh, that's no big deal. That's just my hobby. I come back here and I weld these trees or these animals, and people put them in their yards, and it's just something I like to do on the side. When in reality, he's going to burn his building down, right? And he's going to burn up his car collection. And the insurance company needs to know that. And without that loss control survey, they don't know that risk is there.
We require and partner with our members on letting us know of anything that really goes outside of what the standard risk profile is. For example, we have a city or town that puts up a fire department or a police department. They're required to let us know on those things, and we continually train on that. We remind members to, hey, don't add on big operations without letting us know, so that we can properly insure those things.
Absolutely. This is all related to premium leakage. If you were in the leakage, if you did not see the commercial that Dan Swenson made for premium leakage, you all need to see it. It is fantastic. So.
I would just close with one comment, and that
Please.
is that the biggest risk as it comes to loss prevention and particularly valuations and things like that, I believe, is our false sense of confidence that everything's okay without raising the hood. So, if you take one thing away, it's that false sense of confidence that can really catch us and snatch us.
Because you never know when he's a welder on the side. Thank you all for coming and listening to us today. Steve, thank you very much for joining us and for all your comments.